Is our stock market predicting a recession? Let's have a look. Good evening, everyone. Florian Heiser here, and welcome to another episode of Heiser Says. Stein of coffee in hand, and I thought we would read through this article from the ABC to do with our stock market and an impending crash, or a predicted crash. Let's have a look. So, stock market correction may be imminent for ASX, stockbrokers warn. So Australia's risk of an imminent market correction that would leave thousands of older Australians approaching retirement out of pocket, analysts warn. Several analysts have told PM a major stock market correction is imminent. Reserve Bank Governor Philip Lowe admitted in June he did not understand why the bond market was pointing to a recession while the stock market was screaming boom times ahead. Now let's have a look at, if you're not familiar with it, we'll just explain briefly about bonds. We'll explain about bonds and the difference between the stock market, because everyone is generally familiar with the stock market. But I mean, this is from the ASX website. You know, bonds are a type of debt security. They're effectively an IOU between a borrower, the issuer of the bond, and a lender, the investor who purchased the bond. Just as a bank deposit is effectively an IOU between the bank as borrower and the depositor as lender. When a government, corporation, or other entity needs to raise money, they can borrow money from investors by issuing bonds to them. So essentially, you're buying these bonds. You're buying these bonds under the assumption that you'll get an interest payment, twice a year usually. And, it's not exciting because, we can have a look here. This is the interest rate, security price bonds, and we can have a look at all the ones here. Let's click on this one, the GSB G20. A 4.5% coupon, maturity date 15th of April 2020. We'll have a look here. The issuer is from the Commonwealth of Australia. It's a treasury bond. What will you get? 4.5% per annum, paid semi-annually. Fantastic on the face value of the bond. And what is the face value of the bond? Denominations, $1,000 face value. Treasury bond and $100 face value for exchange traded treasury bonds. Okay, so there's different types and there's some complexity to it that I'm sure many people in the comments would be able to add to more than I can. But for those of you that aren't familiar with it, essentially you're investing your money for about a 4% return, and you're trusting the government to meet their payments. You're trusting them to meet their payments, and which it's probably, the return ain't that good. But what are you guys getting in your bank account right now? Who's getting a 4.5% return on your bank? Even your term deposit, are you going to get that? Are you going to get that on a bond? And the thing is, by buying this, it may, this percentage may be good, but there's the liquidity of the asset. Now, with liquidity, it's how easy it is to exchange it for other people, to trade it, and to sell it. Like, money is the ultimate asset with regards to liquidity. You can just, buy anything with anyone, with money, essentially. It's really useful. And another, what was it? That barter card. I remember I went to a function, they tried to get me to join up there and I'd get all these barter points that I could spend on other things. And I go, well, wait a minute. I actually have to pay tax on your stuff, on your barter fake dollars equal to $1 Australian dollar. And I can't even pay your membership bills in your barter dollars. Why the hell would I go from a currency that's very liquid to one that I can only use in your own little cult group there? So you can imagine how well how well I went over there. But you can see the liquidity is the difference in how easy it is to dispose and trade with that asset. So these bonds are good, but we can look at the volume of trade and how much they're worth. Because that one we looked at, what was it? The face value is $100. The bid is $103. There's no offers. Last yield high, $103. So, and the volume was 200. And what do we have? Number of trades, one trade, 20,000 was the value. So they're not as liquid. You can trade them. I checked on CommSec. There are a few going for sale, but I think there's a bit slower there. So I'm not very familiar with it, but you can imagine that if people are faced with other risks, they might start investing in these, and the value of them goes up. So if you've got some bonds and you've held on to them for a while and you suddenly start seeing them go up because there's talk of a recession because people want to secure their income, say you're a pensioner and you want to invest into something, or you want to keep your 5% coming in every year, you don't care, you're happy with that, it covers all your costs, you put your couple $100 grand in there and it's all good, sweet. and then it goes up, you can actually make some more money. But that's just supply and demand of the market. Then you've got also the stock exchange. Now, this is a great way to measure the stock exchange. It's just the All Ordinaries, and it's 95% of the shares, or 500 of the shares. It was started in 1980 and was indexed. It started at 500, the value, the number, and so it's an index. So it can be measured relative to each other back in the 80s to now, just the value of it. And what we'll do is we'll look at this here. Now, this is the All Ordinaries Index. These are a basket of 500 of the biggest shares in our stock market. And I'm not doing a 30-day trial at the moment on my trading views. You can see here on this number here in the orange, 6,873.2 was the highest that the All Ordinaries ever reached. And I think that was in 2007 or 2009, just before the last crash. I think 2007. And it hit very close to that, 2840, I think, or really close, yes. 2852, something very high on, what was it, the 5th of July, so just a few days ago. So the share market as well, it's going up, the equities market, buying the shares and investing. There's lots of different products in there, but a lot of them are either people are putting money in there to invest in different companies, to get ownership of it, or they're working the market to try and make a profit, to take advantage of some of the changes. But that's a fairly big climb, and it's going pretty high. You can see some of the indicators down here, and they'll discuss these in the article, and we'll go back to them. But I just wanted to make you aware of how close it's gotten to the all-time high. That's the highest it's ever gotten. That's the highest it's ever gotten. So what we'll do is we'll jump back to this article, so you'll just get an understanding of why he's a bit confused, or he doesn't understand why our bonds are going up and our equity market's going up at the same time. The stock market is just shooting up. I'd argue that maybe some people aren't very confident in bonds. I don't know. Well, obviously people are shifting money around because of the changes to the cash rate. That's what's happened. That's obviously a response to this. Now, Pub Test, one of the viewers here, asked me to try and find a way that we could just thank the God Emperor for all of this. And so I told him I would. I'd try and find a way. So this is published on the 5th. Strong jobs growth is back. Payrolls jump in June, well above expectations. Okay, so we've got job growth figures in the US that came out better than expected. Could that be justification for our stock market climb here in Australia? I don't really think so. I'm trying to find a way to justify it. But it actually, these figures were different to what expected, or were better than expected in the United States. So then you saw the spot price of gold started to decrease, so people were pulling out of that. So they were preparing, obviously, for bad figures. And when they came in better, they eased off that. So, I'm still an amateur in all of this, guys. So I'm just trying to get a feel, an understanding of how it all works. But I think just a basic literacy in what bonds are, the stock market, how, the cycles that we have, so people can get a basic understanding of what's happening in the market. I think it's something that a lot of Australians need to have. I think it's what everyone needs to have, really. I blame our education system for barely touching on it, to be honest. So we'll get back to this. So generally, stock markets improve with the economy. So a rise in the stock market normally coincides with interest rate rises. Right now, the exact opposite is true. Something's clearly wrong, veteran market analyst Marcus Padley said. Why are interest rates going to be 0.75% by the end of the year? What's so terribly wrong? You wouldn't imagine there's much wrong if you take the post-election euphoria about taxes and the housing market into account. What do you mean, post-election euphoria? The housing market isn't doing well at all. Properties declining, buildings are falling apart. Anyway, but that's the story being told by the bond markets, and clearly nobody quite knows what it is. But so far, it's been very good for equities, and clearly no one is really considering what the root problem is. Okay, but how did we jump to the bond market there? Oh, it's going up because of the interest rates. Bond markets are screaming economic downturn. Okay. Saxo capital market strategist Eleanor Krieg supports that view. It's highly likely investors are going to have to be a lot more discerning throughout the second half of this year. Okay, so both bonds and equities have delivered outsized returns to date, but someone is going to end up spectacularly wrong, as the current disconnect is actually irreconcilable. If the business cycle continues to deteriorate, equity markets are going to have to face reality and I guess surrender to what the bond markets are screaming, and our bets are with the bond markets being correct at this stage. So yes, I mean, business confidence has shot up, but consumer confidence hasn't. Now, I'm talking to other business owners. I think a lot of people were quite confident with the election results from a business perspective. Now, I know that I'm going to be barraged by the lefties and the socialists, attacking me at that, but you have to realize that from a business perspective, the less red tape you have, the better, and the less uncertainty, and a lot of Labor's policies were throwing uncertainty, and I would even say an element of sovereign risk on the table. The fact that we didn't encounter that was a good thing. So many share market analysts look at charts of the ups and downs of share price movements to gauge trends. When stock prices run up quickly, one indicator, known as the relative strength index, rises above a critical line. It has just risen above that line, pointing to a stock market fall. So here we go. There's the RSI has gone up, and this is the price they check. So let's have a look here. I mean, we've got the RSI at the moment. So it went over this line here, slightly a bit hot, and it's losing momentum. And the MACD, we've also crossed into a downward path, and you can see how it goes down. And I'm not going to explain these terms to you guys, sorry. The moving average, I'd have to look it up. It's been a long time since I went into all of this and started looking at all the chart stuff back in the crypto days. And, I would say that some of it can help you understand what's happening in the market and the trends and how people will respond to it, and just, where if people are buying, if it's been overbought. So there you can see once it hits up, it's overbought, but it had a bit more energy in it, didn't it? It kept going up. So yeah, there's a whole art to interpreting charts. There really is. And I'm not going to try and do it. It took me forever just to get a line on there. And if you're actually interested, this website's TradingView, by the way, and it's really good if you want to look at any shares or stocks or cryptos. It's great, and it's free. For free for most people, unless you're like a nutcase. I think I had like 6 screens of it running at once. So let's get back to the article. Miss Craig warns a major stock market correction is possible. I would say potentially a 10% correction, or somewhere in the region of 10 to 20% as well, she said. Marcus Padley goes a little further in his warning of a market downturn. So clearly a market correction, for whatever reason, if it's going to be a significant one, would be somewhere in the range of 15 to 25%, he said. So, I mean, she's talking a 10% correction, and a 10% correction at 670 is 6,700 is 670, so you'd be down to, pardon me, sorry about that, you'll be down about here. So that's the market correction. I mean, look at me, I said I'm not doing any charting, but I guess I am. Come on, horizon line, say from here, 10%, we'll say 6,000 to make it nice and easy. So that's the Miss Craig's market correction, and he's talking 25%, so we're saying for that. So what we'll do is, we'll bring up my super duper calculator. So what we'll do is times it by 8. So he's talking down here. That's a 20% fall. So what we'll do is we will zoom out. When did we last hit this line? And that was in November 2016. In November 2016. What happened in November 2016? Maybe a significant decline in foreign investment into our residential property sector started easing off in November 2016. So there we go. There we go. So we'll jump back here. So those are big calls, what they're saying. You know, maybe easy just to throw out 10, 20%, 15 to 25%. But when you look at it in this perspective and how much you're going to fall, I mean, boom, boom. If that happens rapidly, that's going to be, it will have a significant emotional impact to people. I would argue that you've got to understand with all of this stuff, with all of the trading, and there's a lot of it is psychology. A lot of it is actual psychology and human behavior. And we're not rational creatures, not in anything. And, you know, decline of the market over a steady period with ups and downs, slow and gentle, is not going to have the same impact on people as a sharp decrease. So if it crashes down at a very fast rate, I mean, that's definitely going to push for a recession, I would argue. But also it will cause people to make less rational decisions or less well thought out decisions. One thing you learn about any of the people that do this type of stuff, like on a day-to-day basis, the day traders, a lot of them, psychology is a big part on it, and they've got to be able to handle the stress and just the rapid movements. If you want to see rapid movements, invest in crypto and just see some of those go crazy. Oh, you know, you're up, I think 10,000% or 1,000% was the most I ever went up on an investment. That was crazy. And boom, straight back down. So if there's a major rattle, recovery should be quick. Okay. A big stock market fall can cause a lump in the throat for anyone heavily invested in the share market or who is approaching retirement. As the stock market approaches a record high, a key measure known as the price-to-earnings ratio shows shares are above the average relative to earnings. But analysts say this is not at extreme levels. So the price-to-earning level, I mean, there you go. Private client advisor James Rosenberg advised people to ride out any bumps. Don't forget that good companies are good companies, whatever their valuation, whether their valuation is high or low, Mr. Rosenberg said. Okay, so if you do own quality investments and the market does have a significant correction, just ride it out. Well, yeah, I mean, if you're a long-term investor, you're not too worried about it. If you're in it for the long term, you just don't want it to get to you. But if you need to, you know, cash out of that soon, Ms. Craig said retirees should start thinking about where growth is heading in the next 12 to 18 months and whether they want to remain fully invested in the share market. Well, I'd hope that they'd have a diversity of investments, but then a lot of people don't really have much control over your stocks. But if it's in super managed by other people who can lose it all for you and still make money off the top. Really make sure that overall your portfolio has a low beta, she said. This means that when the market moves down, your portfolio is not going to be susceptible to that market volatility. So that means you'd be maybe investing in bonds. And maybe that could be why bonds are going up as well. Maybe people are putting money into the stock market, they're putting money into bonds, because other ways to generate revenue has declined. I wonder, do you think, guys, you know, just a penny, you think this increase here could be, you know what, I need to track Opal Tower, Lacrosse Tower, all the major construction industry news and really apartment disasters that we've talked about, and chart it on here to see if that has actually made an influence. If more people are shifting their resources out of property into these things, into the stock market, do you think apartment scares would affect, you know, the all ordinaries? I don't know. Maybe it would. Maybe it would. Let me know in the comments. What do you think? If we have any analysts there that can help me learn some things, I'd appreciate it. So small investors looking to the long term. Cayman Wong, an investor from Darling Point, New South Wales, has taken the advice on board. I'm personally looking for something in healthcare or in high-tech industries, he said. Mr. Wong is aware that the stock market could fall over at any moment, but as the father of a young daughter, he is thinking long-term and wants to start building a nest egg for her. I'm basically looking for a long-term investment, and the current situation or the pricing currently will not be affected by my long-term investment strategy, he said. But other investors are nervous about the potential for a market correction. Former school teacher, 75-year-old part pensioner Peter, is still licking his financial wounds after a recent investment went south. I just lost $60,000 by selling Bank of Queensland when it was tanked for a few months, he said. Okay, well, I mean, did you lose it? Why did you sell it then? Did you have to? You only lose, when the price goes down, you only lose if you actually sell it. It can always come back up. That's called holding your bags in crypto. The stock crash came at a particularly bad time in life for Peter. His daughter, recently divorced, needed help paying her legal fees. So Dad had to step up. Yeah, that's a shame. It's pretty grim, he said. I should have kept Bank of Queensland, but seeing I sold them, I'm just staying with Westpac and getting their dividends every year. I'll get some in November. When asked if he was worried about a correction, Peter said, only from the point of view that it went down really badly. Okay. So, interesting. We're getting conflicting messages from our market. What do you all think is going to happen, guys? What do you reckon? Do you think we're trending down? Do we have any day traders that are using TradingView? Let me know how you think. We'll have to wait and see. I mean, consumer confidence is still low. I'm talking to people every day in business that are facing challenges. And, I think, housing is starting to go lower. Apparently, in the pain and gains report, more people are selling for a loss the last first quarter of this year than recent times, for apartments in particularly, selling at a loss. So I thought I'd just read through this and let you all know about it. Guys, let me know what you think. I'll see you tomorrow. Bye for now.